Ladies and gentlemen, stocks are back under pressure today. So much for a continued rally. This comes following Nike and FedEx earnings last night that were both just really bad, especially what they had to say about the consumer. Now, Fed Williams and Fed Goolsbee today, the first two Fed speakers we have heard since Powell's speech at the podium, sounds cautious on the economy.
Why?
And I will share that with you in this video. We also have some comments from Trump's conference today that you should hear. Now, the headline of this article here says Chicago Fed President Goolsbee sees rate cuts depending on inflation progress. Like, that headline does not scream the actual context of this interview. Goolsbee was on CNBC. There's one thing particular here, one paragraph that kind of sums up the whole interview and just goes on to show how nervous they might be. He says, quote, "When you got a lot of uncertainty, I do think you need to wait to see some of these things get cleared up on the policy side, of course." He says, quote, "I'm out talking to business people and civic leaders throughout this region." He's the Chicago area president. "And there's been a decided turn in these conversations over the last 6 weeks of anxiety, of pausing, waiting on capital projects, CapEx, etc., until they figure out tariffs and other fiscal policy." That, my friends, is a nervous Fed. That is a Fed that is worried about the economy. If you are waiting on capital projects and CapEx, you're probably not doing as much hiring as well. So while CNBC can push whatever narrative on the headline that they want, the actual conversation with the Fed today was not super optimistic. At the same time, New York Fed President John Williams noted a high level of uncertainty around decision-making and economic trends, particularly inflation. He says, quote, "Recent data, both hard and soft, are sending mixed signals. Measures of policy uncertainty have increased sharply in recent months." Even the FOMC noted yesterday that, quote, "uncertainty around the economic outlook has increased." Jerome Powell used the term uncertainty 10 times in his post-meeting news conference. Look at this pretty blatant warning from Fed Waller. Fed Waller says the Fed has tools available to mitigate unanticipated market disturbances and should rely on these and develop a plan to respond to any short-term strains. Fed Williams says it is hard to know how the economy is going to perform, and again, that just highlights the Fed right now has no idea what's going to happen with the economy. Like, your guess is as good as theirs. He says that many different economic scenarios are possible right now. He says there's a lot of uncertainty in the economy and policy right now. And he says that he expects growth to slow in part due to lower immigration. Fed Goolsbee says evidence is mixed on how sentiment influences activity, but contacts in the Midwest say confidence is changing how they behave. Fed Goolsbee says uncertainty could feed into company capital plans, also sap confidence. Fed Goolsbee says the longer the Fed waits, it may mean the cuts have to be backloaded. There can be a cost to waiting, basically saying that if they wait too long and the economy weakens too much, they're going to need to cut more. Fed Goolsbee says that imports are only 11% of GDP, so one-time tariffs that are not followed by retaliation are more likely to be transitory. Now, Donald Trump today was really stirring a lot of things up in markets. Trump reiterates that on April 2nd, the U.S. will get its money and respect back, so doubling down on reciprocal tariffs for April 2nd. Now, listen to this. Fed Goolsbee says that current conditions are maybe a shock to the economy depending on how long they last. Do you know what causes recessions? Shocks to the economy. The economy is very diverse and good at handling situations, okay? If there's certainty and they don't last too long, and they're kind of slow moving, markets can react to that, right? The economy can adjust, but it's shocks to the economy, fast changes that you cannot, adjust to quickly that cause recessions. Now, U.S. stock indexes paired declines after Trump says there will be flexibility on tariffs. And Trump says that we are going to have a full ceasefire very soon in the Russia-Ukraine war. That is also helping to boost markets. And Trump says that Europe is lowering car tariffs. It's nice. Trump says that tariffs are fair, and yet again says he is not a fan of the CHIPS Act. And what Trump really said is there will be flexibility on tariffs, that basically it's reciprocal. So you drop your tariff, we'll drop our tariff. That's a pretty good guidepost to go off of. Trump also says that there is a lot of people asking for tariff exemptions and kind of shoots that down. He says that once you give one company an exemption, you have to give other companies exemptions. That exemptions really don't work. And Trump says that he will speak with China's president. And he says, quote, "We can talk about China tariffs." And he says that now some of that money will come back as tariffs. Now, this news came out during Trump's press conference as well today. It says France is said to float using EU's most powerful trade tool on the US. Honestly, I don't know what that is, but it sounds ominous. Now, again, also putting pressure on markets today, Nike expects sales will plunge in the current quarter as it faces tariffs and sliding consumer confidence, like plummet 14, 15-ish% year over year. That's not really a sign of a strong economy, to say the least, and FedEx is now the latest company to again sound the alarm on the U.S. economy. FedEx used to be seen as a bellwether company to the state of the economy, meaning that, if FedEx had good things to say, that was a good sign the economy was doing well. But if they had bad things to say, it was a pretty clear sign the economy is not doing well. Now, a lot of the weakness came from FedEx's higher margin B2B volumes. This is business to business volumes, which is, not a great sign from the business sector. FedEx saying, quote, "Continued weakness and uncertainty in the U.S. industrial economy is hitting demand for its business to business services." I think some of this has to do with the trade war and uncertainty around policies even coming out from Washington, and that slowdown in capital expenditures and business activity, generally speaking. Also being reported today, CTAs are net short equities for the first time since 2023, and we don't see them relieving this position until after April 2nd tariffs. And some people speculate there could be a short covering rally that follows that. But really, as you can see here, they were net short from January 2022 as well, right? And yes, here did mark bear market rallies in 2022, but you were negative, for a long time. Like 2022 was a bad year, and first going negative was not a sign that the rest of the year was going to be good. So I would push back a little bit on this, even if you do, again, get a short-term kind of bounce. It doesn't tell you much about what the next couple of, 6 months or so is going to mean for markets. Peter Burson says, "I don't like the term dead cat bounce for the same reason I don't like the imagery behind Schrodinger's cat thought experiment. It's needlessly cruel to cats. Be that as it may, my macro quant model suggests that the recent bounce in stocks won't last long." Also being reported today, Small Business Administration to cut more than 40% of staff. And United Airlines has said it is seeing a 50% drop in government-related travel. And it is being reported that Elon Musk was at the Pentagon to address costs. Now, here on the day today, the CNN Fear and Greed Index is at 22. It was at 21 earlier today, so you have definitely seen it move up 1 point, but you're kind of just stuck around 20, 21, 22. It's really not moving much. That is because almost all of your major categories here are in extreme fear. Market momentum, extreme fear. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, extreme fear. Market volatilities, neutral, safe haven demand in extreme fear. And junk bond demand in greed. Like, all you have is market volatility and junk bond demand. If those start to fall closer to extreme fear, then the CNN Fear and Greed Index will get worse. Now, the percent of stocks trading above their 50-day moving average down to 28.5%, down about 3% today. That's actually down 9.15% if you look at the overall total today, which is kind of crazy. If you look at XLP, consumer staples, down about 0.1%. Momentum barely in the red. So if you want to take a positive away from this market today, is momentum is well, almost going positive here now. So momentum starting to outpace some of your consumer, staple companies, which can be a positive sign. Now, your AI investor sentiment survey that came out on Thursday shows bullish investors at 21.6%. That is a uptick from 19.1% last week. Neutral investors fell to 20.3%, down from 21.7% last week. Bearish investors remaining pretty sticky here, coming in at 58.1%, down a little bit from last week's 59.2%, and the prior week still being higher than 57.1%. So still, people do not feel bullish out there, which is pretty remarkable given the S&P is only down about 8% from all-time highs. This almost never happens. Like, you're at the same level of bearishness for a 3-week extended period you've been at, or really 4 weeks now, since like 2009. And part of the things that, that makes me a little nervous right now for markets is the fact that you've reset some of your velocity indicators, like the VIX. The VIX is still high. It's at 19.69. It's actually down 0.5% today, but you're not at 29 anymore. We were at 29.5 on March 10th. That was just 11 days ago. But look at the S&P. The S&P is 2.5% or so away from a new low. So what does this mean? Theoretically, on Monday, you could fall 3%, hit a new low, but the VIX is not going to be at 30, right? It's not going to be at 29.5. It's probably going to be at 23 or 24. So now you have room to move lower without, seeing the VIX at a new high, without indicating that you are, vulnerable for a bounce. Same is true with the RSI. The RSI is now at 40.5. You're not oversold anymore. So if you hit a new low, the RSI is not going to hit a new low, right? This is what you had in 2022. That's why you get bear market bounces, because markets can, only be oversold for so long, right? You can only fall so much so quickly before you get a bounce. You've seen the first bounce in January of 2022 when you got this was a peak to trough decline of about 13%. And then you were really oversold. Markets bounced, but what happened? You continued to hit lower lows throughout that year, but you never got as oversold as you did on the first drop. But yet the S&P was only down less than 13% during that first January drop in 2022. But from peak to trough, you actually fell almost 27%. So that's kind of the issue that I see with markets today. You're just now kind of being set up for a move lower, in my opinion. Now, it's ultimately going to come down to what happens in the economy. Are we going into a recession is the big question. And again, the simple fact of the matter is, if we go into a pretty average or normal recession, you're looking at about a 40% decline from here. So that'd be 50% peak to trough. Now, where do I get 40% from? The average decline in EPS during a normal recession is about 15%. If you take 15% off of 2024's EPS, you're looking at about $201 per share for earnings in 2025. Again, if you just have an average recession, times that by the average recession multiple of 15.5 times, you're looking at about $311 on the SPY, right? $3,100 on the S&P 500. I mean, that's going to put you down about 45% from here. Even if you go on the high side of the multiple, and that's about 17, you're looking at 341 on the SPY, which is exactly, almost exactly your low of 2022, which would put you down about 39.5% from here. That is not a comfortable position, I would say, for the broader markets. Now, if you also look at the weekly candlestick chart for the SPY, you're sitting at a very critical level. You're sitting at your 50-day moving average. We really have not been below that since early 2023, when you had like part of the banking crisis, right? The last time you broke below this was really 2022 in February here. And that ultimately led markets to fall from that break another 20%. So I would just be a little careful here with the setup that we have, kind of resetting some of our velocity indicators. The downside is much larger than the potential upside. That you need to know, right? Because it's not always like that, right? Sometimes the upside is more than the downside risk, right? This time around, it's not. Recession could be in play here. And if that's the case, you're looking at 40% downside potential. You don't have 40% upside potential if we avoid a recession this year with the current dynamics that we have. Like at best, 10, 15% upside from here is about doing it. So you have like potentially 5 times more downside than upside. And that's a pretty scary ratio. So with that said, ladies and gentlemen, let me know your thoughts on all of this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.